Okay, folks, welcome to Volume 3 in the Inner Circle Traders Market Maker Collection. This is the third installment of 12 in the continuing series. And this one is going to be dealing with understanding institutional manipulation and stop running. Now, if you have looked at all my older series and some of the particular modules that I taught regarding stop runs and raids, and utilization of what a concept I call Power 3. We will be revisiting that in this particular module, and we're going to be focusing on true day. Okay, what is true day? True day is a concept that it outlines or gives the framework to the overall daily range and how the dealers work within those specific time frames. We're going to be talking about the implications of that and the blending of True Day and Power 3 together to give you a more clear view as to what's going on a daily basis in the marketplace. And we're going to be introducing the idea of stop runs and false price swings. And we're going to be building on the framework that leads us into the next two installments where we start dealing with a lot more specifics as to how stop raids are utilized, how they are set up before they happen. You'll know exactly when to anticipate that occurring, and if you happen to miss it, how you trade with it on the left side of your chart. In other words, how do you use it if you've missed the opportunity, or if you were an unfortunate loser in a particular setup that you had taken action in. If it stopped you out, how do you go back in and take advantage of the raid that you were unfortunately a participant in? So let's get a better look at what specifically we're going to be dealing with in this series, and let's go over to the price charts and build some foundation for this particular teaching. Okay, we're looking at the British pound versus the US dollar, or what we commonly refer to in Forex as the cable. Okay, I want to ask you a question, and this is going to be more or less framed on the basis of what we shared in the first and second installment of this series. And I'm going to ask you, we outlined the idea that in the middle of this 2014 time frame, we had a pretty significant high placed in the British pound USD pair. And we talked about the framework that led to being the catalyst for that high in the marketplace and the subsequent low in the dollar index in the first of this video series. And then in the second installment, we were talking about further details as we utilize these higher time frame macro principles. Okay, now we're going to take it even one step further, really going to give you the understanding to build the framework for you as a developing trader or someone that's been doing it for a long time that just doesn't have the consistency that you're looking for, or you actually have intermittent consistency, which is typical of moderate length of time in terms of trading. For those that have been in the markets for a while, you still may not be as consistent as you'd like to be. This particular module is actually going to be a supercharger, okay, for those that aren't familiar with some of these concepts. They're absolutely unique to me, and I think you're going to be very blessed by it. And I want to ask you a question looking at this chart. When we see the high in the markets like this, okay, when we're looking at the price up here making its high, okay, and then starting to trade lower, the common question is that the noobs or neophyte traders, okay, I don't mean that to be rude, okay, it's just what it is. I was a noob a long time ago too. The looking at charts like this, I was always intrigued with what was the catalyst that led to these moves like this? Because my understanding is this, and it's probably along the same lines as you as a trader. Okay, you look at these charts and you say to yourself, man, if I could just know when the market's going to do this, okay, and then have these prolonged moves, all I could do is simply to sit back and wait for these types of moves, okay, and then I would just trade those and hold on to it and do very well. And I would agree with that. Okay, the problem is the retail universe and all of the pseudo gurus and teachers out there that supposedly know what they're doing, they don't teach what we're teaching in this entire series. Okay, and the reason why they don't teach it is A, they don't know it. Two, they've never been exposed to my work. Okay. Or three, they may know it and aren't sharing it with you. Okay. And that's absolutely within the realm of possibility. So I'll leave you to decide which one your particular guru is, or author, or teacher, okay, that you haven't had exposure to, which one of those three camps he or she resides in. Either one, okay, you've been left in the dark as it relates to this type of information. And I can assure you that if you're blown away by this installment, you're going to get absolutely knocked out completely, okay, with the subsequent, five installments behind this one. Okay, so knowing that in advance, and I know there's a whole lot of build up, as we're talking here, and you just want me to get right into it. I just want you to understand something. This was the beginning foundational turning points for me to be consistent. So a lot of folks will email me over the several last 4 years or so, really, since I've been specifically teaching only in Forex. 1998, I was in commodities trading. Okay, I didn't have as much feedback then, and I wasn't really readily accessible then as I am now in the Forex industry. So I get a lot of feedback via email, 300 to 400 emails on a daily basis. So there's a lot of, you know, correspondence I get and questions. And the number one reoccurring question is, how do I know, or how can they, as the emailer sending the inquiry to me, how can they know with certainty that a particular move is underway? And I will say this: I don't know with absolute certainty that a move is going to ensue. Okay, I never, no one never does that. Okay, but I can give you the highest probable conditions where those moves that we anticipate, where they will reside and how they'll occur. Okay, I may be off by one day, okay, in terms of a higher time frame turning point. Now, again, I'm saying this with the understanding that I do not want you believing that you can go in and pick major tops and major bottoms on a consistent basis. You don't need to do that, okay? But once you start seeing these major tide changes, okay, on the higher time frames, it gives you the confidence to work within that overall directional premise. Okay, so a lot of folks will ask me, how do I know if the day's going to be up or down? Well, I really never know that for certain. Okay, but I'm going to give you again the framework to know how you have statistical odds that you can look at and go back over your charts and look at it. Okay, and study it on your own. Don't take my word for it. Don't let me just give you the examples in this video here. You, as the developing trader and viewer of this series, I want you to go back through your charts, whether it be Forex or whether it be any asset class you want. Go back and look at the markets like this, and you're going to see clearly that there's an absolute reoccurring phenomenon that goes on and on and on every single day, and it happens consistently enough that even if you're wrong once or twice in a week, you can still go out in that same week, if you're controlling your risk, and if you've taken a loss, you can pull that loss back to a break even and even move to a profitable state going into the close of that week. Now, because we are looking at the higher time frame premise like this, and we're looking for the overall institutional order flow on a higher time frame, what we're looking for is this major move higher or major move lower. Okay, but how do we know when we can anticipate those types of moves, and then what do we do once they occur? What should we anticipate seeing as a result as these moves take place in the marketplace? So what is it we're looking for? Well, obviously, looking at this chart, we can clearly see that the market made a high. Now, I know everyone out there is saying, okay, great, wonderful, Michael, this is a hindsight, perfect scenario. I know, obviously, it's a high. We all been seeing it for the, half of the year going by in 2014, I'm sure. But looking at the cable like this, okay, focusing specifically on the fact that we made a higher high right in here, okay, this is a raid on those participants that were selling short up here. Now, this right here is a raid. How do I know with absolute certainty that that is a raid? Well, you never really know until on a daily basis the very next day. The very next day is here. Now, I'm going to ask you a question. If you are trading and you say, okay, I want to be a part of moves like this. And if you're telling me that you have to absolutely be in on this day here or you're not going to be satisfied, well, turn the video off because I don't have anything for you. Okay. But my question is this. If you were one day late, you were Johnny come lately, and you were in on this day or even the very next day, does that really bother you in the grand scheme of this huge move going down? Okay. It's possibly going to go lower going into the latter part of the year. Closing this year out, we may be going into, a much farther decline on the cable. We don't know that, but looking at this chart here, we certainly know that the probabilities are certainly there. Okay. Now, I want to ask you also something like this. Okay. When we made the higher high here, okay, we learned in the very first video of this series, we qualify price swings with the dollar. Okay. And I introduced the concept of an ICT USDX or US dollar index SMT divergence. Now that's SMT, smart money technique, or SMT, which is smart money tool. What it is you're looking for a break in correlation. Now, if this in fact was a confirmed high, market structure should be confirmed with a lower low at that same time in the dollar. Okay, remember the British pound USD is going to be a mirror image of the dollar index. So if this is going lower, we should be seeing a move higher in the dollar index. But more specifically, how do we know when there's professional accumulation and distribution going on in the marketplace? Because think about what that's saying to you is, if you're looking at the charts with that understanding or that premise in mind, not looking at indicators telling you if it's overbought or oversold, looking for specific divergence, bearish or bullish, that means absolutely nothing. If you're going to reach for indicators to tell you whether or not you should be a buyer or seller, okay, you're taking the eye off of what's important. Everything you need to know about the directional premise of a particular asset class is going to be revealed in the market by looking at simply the chart itself. Do not look at anything like a MACD. Don't look at a stochastic. Don't look at an RSI. Don't look at anything of that nature. No CCI, none of that stuff. It means absolutely nothing without the framework or premise behind it, as we're going to disclose in this particular video. Now, let's take a look at the dollar index. Now, let's take a marker of this. We're looking at the first week or so, the first 2 weeks of July. Okay, we made a higher high in the cable. Now let's go over and look at the dollar index at the same time, and we can see that the dollar index was absolutely unwilling to go lower. You see it had made a higher low there. Okay, so comparably, what this is showing to us is, again, it's the ICT USDX SMT divergence. Now it sounds like a whole mouthful, tongue twister, okay, but just understand this. All it's saying is that the dollar is unwilling to go lower when the cable was willing to make a higher high. Whenever you see a break in that correlation, because there should always be a higher high in one and a lower low in the other. It doesn't make a difference, just flip it. Okay? In other words, if the cable was making a lower low, there should be a higher high being made in the dollar at the same time. If you start blending time of day, if you start blending day of week, if you start blending quarters of a year, every 3 months, there's a cycle that takes place like this. Okay, if you're looking for intermediate term swing trading, and we're going to talk more about that specifically later on in the series. Or if you're a position trader, okay, if you look at seasonal tendencies on an annual basis, okay, like we were discussing in the first video series of this video series, we can narrow down when the overall probabilities, okay, for a particular move to take place. Now let me ask you a question. This is going to be very, very fundamental and elementary question, but think about this for a moment. When do you anticipate snow? If you're in a region in the world where you get snow, because I know some of you guys live in the tropics and you just don't know what snow looks like unless you've seen it in a movie or such. But when would you anticipate snow? Obviously in your winter months. Okay, I live in North America. I live in Baltimore, Maryland. So I know, coming into November, as early as November, sometimes as late as March, sometimes even early April, sometimes we'll get a freak snowstorm. Okay, that's seasonally when we would anticipate snow. I would never anticipate snow in June. It just wouldn't happen. I would not anticipate that. Now, I know you're probably thinking, okay, what's this have to do with anything? Well, it means this. There are specific cycles in the money flow, okay, that goes through the marketplace. Okay, and there's a seasonal tendency where it's so generically inherent for a market to move higher or lower around specific times of the year. If you just simply wait around for those times of the year and do these principles that we're teaching from the higher time frame perspective, it will absolutely make trading easier than it is for you right now. Now, notice I did not say profitable, because I can't make a promise that you're going to be profitable, because I can't control how you're going to use this information. I'm not going to be there to put the trades on for you and close the trades out when it's the optimal time to do that. Okay, but I'm going to give you the framework so you can make an educated decision based on the generics that are in the marketplace that no one else talks about, and more importantly, knows how to piece together. That's been my primary agenda, okay, as a trader. I've already tasted success. I know what it's like to make money. Lots of it. But more importantly, what I've done is I've looked at everyone else, because actually I have a character flaw, and I'm going to admit that to you openly in this video series. I'm rather narcissistic, if you haven't noticed. I believe that I'm right in everything, okay, and it's not alien to trading. This is the reason why I do not like folks sending me their opinion about the market, what they think is going to happen, because the way I'm wired, I am contrarian to the core, because that's how I've been bred as a trader. I view everything contrarian. So in other words, if the general populace or retail universe is telling me that they believe that the cable is going to go higher, okay, and let's go back to that cable chart. If the populace abroad in the retail industry are saying this is going to go higher, and if you go back and look, everybody was tickled pink thinking this is a bull flag, it's going to go higher. At the whole time, we were anticipating a seasonal decline. We were anticipating a breakdown sooner or later around that same time frame. Okay, now again, we're looking for the technicals to support it, but if I go into the marketplace, okay, with someone else's idea, the first thing I'm going to do is I'm going to go in and look for the opposite reasons to do that. Okay, that's just the way I am. So I don't want you to believe for a moment that I'm going to give you the absolute get in, get out every single day of the week type of trading. I'm not going to be able to do that, okay, because I don't trade that way. Now, if you're a nutcase and you have to do those types of trades, then sure, these tools will help you be in there all the time, every single day, between the London kill zone, the New York kill zone, okay, no specific times of the day that we'll be teaching specifics on, okay, you'll have opportunities to trade. Some trading setups will be better than others, okay, but if you work within the framework that's being divulged in this particular installment here, this will give you the basis to frame all your types of trading that you could ever imagine, because it's working off of the higher time frame. Okay, so I know I'm going on a long-winded rabbit trail, okay, but I want you to understand that there is absolute power in what I'm showing you, okay, and don't discount it, don't take it lightly, okay, and I promise you, if you study these concepts and you put it to task, you will be far better beyond where you would anticipate have been in terms of development than you had not done it at all. Okay. So now, with all that preamble, let's go and look at what specifically we're going to be talking about. This SMT divergence, where we made a higher high in here on the cable that was not reflected and supported with a lower low in the dollar index here. Okay, that's an SMT divergence. Now, that's not in any books. That's not in any course. Okay, no one's teaching it. No one talks about it but me. Now, it's not about being ego. Okay, I'm just telling you, you have learned something that is completely alien to the retail universe. They have no idea that this even it exists. Okay, or if there's any significance to it. But what it's telling you is this higher low, okay, is the dollar being accumulated. Accumulated, what does that mean? There's going to be a large influx of buying interest by the smart money. Banks are going to be all over this bad boy trying to get long. They want to be buying the dollar up, buying it, buying it, buying it. Now, the market's only going to move like this by deep pockets. Retail traders are not doing it, okay? The guys that are, on the forums, they are not making this move happen, okay? They may be lucky to be in here intermittently many times, but they're not moving the marketplace, okay? Banks, large funds, they're the smart money. They're the ones that we're trying to ride the coattails on. If we know that the dollar is being accumulated, okay, it's unwilling to make a lower low at the same time that the cable was making a higher high, we understand then clearly this is a stop run. It's running out the highs here. So anything beyond this point here to the right of that going forward, this should be a selling scenario if it rallies. So every rally should be viewed as a suspect rally or a Judas swing. Now, what is a Judas swing? A Judas swing is, you ever look at the marketplace, you're sitting in front of your charts and all of a sudden it just shoots up for no apparent reason to you because you're looking at a 1 minute chart. Okay, it starts vaulting vertical. Okay, you have no idea why it's happened. You immediately start looking at your your news wires. What happened? Did someone drop a bomb? What's going on? Did someone die? Something. You want to see what's going on. Or the trigger happy guys, they're saying, wow, it's already ran up 30 points. Okay, I'm getting in now. I'm buying it. Okay, have you done that before? I've done that before. I got no problem admitting that type of actions. I've done that. And anybody that hasn't done it, okay, or admits to it, you're lying. Okay, you're just lying. So just, let's be honest with one another. Okay? We know what each of us has done and what you're most likely going to do if you don't pay attention to what's being shared in this video course. Okay? I'm trying to help you avoid all those things. But when we have a premise on a higher time frame like we have here, okay, this is distribution. This is all being sold here. Why would they run it up here like that? Because these individuals over here that were on this high going short, they were right. Well, the banks are greedy just like you and I are. And don't say you're not greedy, guys, because you are. Okay, you want more than you have. By definition, that's greed. Okay? Admit to it. We're all sinners. Okay? Talk to your pastor. You need some redemption. So the bottom line is, when we see these types of things, we can clearly know in advance, okay, going forward, that we want to be selling rallies. Now, what does that look like? What does selling a rally look like? What does that mean? Okay, well, what we're going to do is we're going to talk about the power of three. So before we get into that, I want you to take a look at this chart a little differently. We're all used to seeing candlesticks, but now we're going to go to a bar chart. Whoa, a little harder on the eyes, I know. Okay, but this is how I learned how to trade. Now, the idea of Power 3 comes from several entities. Okay, number one, the first one came to mind was Larry Williams, because he taught the open to close relationship. Here's what I want you to take a look at. We're going to use this candle right here, or this bar. The low here, okay, and the high here. See that? Obviously, the close is higher than the open. When I learned from Larry Williams, okay, he taught that he wished that just the zip codes of the traders that were buying down here below the opening, he wished he knew them, because if he could just get in touch with them, he believed that he would do very well in understanding, maybe even riding their coattails as well. When I heard that, I wanted to go into the marketplace with the premise behind everything that I do that I'm going to figure that mystery out to him. Okay, in other words, if it was a mystery to him, this guy's the one that took $10,000 into $1.2 million, okay, in 1 year, and he did it in 1987 when it crashed. He got hurt a little bit. He's actually up more than that, but ended up making it back to $1.2 million. Now, is he as good as a trader as he may seem in all his works? No, he's not. But guess what? He readily admits he doesn't have to be very good because of his money management. And that's something that we're going to talk about in the end on the 12th video when we talk about mega trades. But if you look at his trading, he doesn't even utilize the things that we're talking about. So while I am something of a protege of Larry Williams, I believe I've evolved beyond his understanding as it relates to price action. I know that's going to be very egotistical sounding to most of you, okay? But I want you to not just take my word on it. I want you to see these things happen in your chart. And when you start seeing it happen real time before it happens, you're going to be like, what in the world? Yeah, it's going to be just like that. It's going to be like, you have no idea how confidence builds on this, and you'll absolutely know what it is you're going to be doing on a daily basis. And you'll know exactly what you're going to do. You're going to look for the specific pattern. You're going to look for a specific criteria, a phenomenon that takes place repeatedly over and over and over again. And then what will happen is you'll know that when markets are predisposed to go higher, you'll know how to view the opening price and what goes on below it, okay, to get in going long and not be fearful of it. Holding on for the entire day and getting out and trying to get the lion's portion of the move, which is what we refer to as the profit release phase of the Power 3. The first of the three is the open, which is the accumulation stage, either the accumulation of longs or shorts, and then the close is the distribution phase, where whatever the high or low is formed, if it's a down day or up day, okay, those positions are distributed. Okay, so without going into further detail about this chart here, we're going to come back to this chart, but for now, let's go and revisit the concept of the ICT Power of 3. Okay, guys, we're looking at the Power of 3. Okay, this is an old teaching of mine. We're just going to retouch on some of the salient points with it. I won't spend as much time as I did the last time going through it, but if you've been following me for a long period of time, there's a torrent on the internet. You can go ahead and snatch that older teaching, but I think you'll be pleased to know that this is going to be just as good, just not as long. All right, what is the Power of 3? Now, before we as traders obviously can come to the realization of consistency that we all look for in trading, okay, we first have to understand there are 3 consistency factors that you need to implement in your understanding of price action. Okay, and there's 3 cycles, if you will, okay, that I teach, and the first being the accumulation phase. Now, what is the accumulation phase? Well, because we want to be trading on the heels or coattails of smart money, our understanding is we want to be getting in when they're accumulating longs, buying long in the market, okay, and hopefully being a flea on the dog's back, okay, as price moves higher, we would stand to profit as a default based on their actions, not ours, okay? And the accumulation phase can be in the same vein on the short side as well. Before the market goes lower, okay, when we want to be in there, participating on the short side of the market too, before the largest portion of the move takes place, okay? And obviously the profit release phase is when the profits are seen in our trades. This is where we see range expansion. And range expansion is when in terms of speaking of the daily range, okay, if it's going to be an up day, okay, in other words, the open's near the low of the day and the close is near the high of the day, okay, obviously the most likely scenario for that day for profitability was those that are long in the day. Now, because there are traders that are scalping all day long, okay, they could have scalped intraday going short during that up day and made money. And I'm not going to argue against that point. But my question is this: why would you want to do that? Why would you want to stand in front of a freight train when the probabilities are much greater for an up day based on some of the things we're going to teach now? Why would you want to sell in an up day at all? Why would you want to do that? Why would you want to do that when it's so limited in capacity in terms of profitability versus the unlimited side of the longs? Because I've always learned something that Larry Williams said early on in my development in one of his seminars. He said in really strong bullish markets, they will go much, much further beyond than you anticipated. And it's true. I've learned to accept getting out of the markets early and being content with that. I used to get mad and didn't hold on to that last little bit. But when you start making money like this, you don't really need to worry about all that. Let them keep some on the table for the rest of the people. You got to have some for the rest of the tribe. And obviously the third phase is the distribution phase. Now, the distribution phase is absolutely the opposite of what the accumulation phase is. Okay, whatever position was accumulated, whether it be long or short, the distribution phase is the distribution of that position or those positions held by the smart money. In a bearish market, okay, this would be distributing those shorts by buying it back. Okay, and the public will be selling it, okay, or taking the other side of the smart money. And what we do is we want to be in the middle portion before it happens, during the accumulation phase, riding out the profit release portion, and then getting out when everyone else is talking about the move. That's the distribution phase. Okay, that's Power of 3. Now, The specifics of Power 3 hinges on the understanding of the opening price. Now, the reason why I'm talking in regards to price with an open, high, low, close bar and not a candlestick is because I want you to clearly see what's going on. This is how I learned it. This is how I studied it in price action for a lot of years, and I want you to learn it the way I learned it. Okay, if you can see it happening in a candlestick, fine, it's wonderful, but it's easier for me to describe to you with the open, high, low, close bar. Now, without having any basis of it being an up or down day, okay, we're just going to look at the opening price. If this is going to be a down day, and there's going to be a lot of things that we can use to build the framework on understanding of anticipating a down day later on as we go through the series, and some of the things we'll be mentioning in this particular video itself. But if we are looking at a down day or a lower close on the daily basis, okay, or daily chart, the move above the opening price is where smart money distributes. What are they distributing? They're distributing shorts. Okay, they're distributing long positions, and they're accumulating short positions. Okay, let me rephrase that in case I confused you. Any move above the opening price, smart money will be assuming shorts and unloading longs. And more importantly, in the retail universe, what they'll be trying to do is lull the less informed crowd, or what we commonly refer to as the dumb money or street money or retail universe. They will be lulled into believing that the market's going higher, and they'll buy that move going up. That move above the opening price is what I dub the Judas swing. The Judas swing is a false rally to lull in traders believing that it's going to go higher. Many times the speed at which it moves, okay, is the indication that we look for. Okay, the faster, the thinner the move it is, the better it is, and we know that it's a suspect rally, and we can sell right into that and not have any fear at all. And it's going to be a little bit of a paradigm shift for some of you, because seeing a fast move going up, reactive state and bind will be, I want to buy that as a retail trader. And we as smart money traders, we do not. We look to sell into that. Okay. Now, conversely, if we are looking for a bullish day where the close is higher than the opening, okay, the smart money will be working below the opening price in the capacity of going long, and they will be distributing short positions. Okay, and if they've been holding shorts, they'll unload them below the opening price, and they'll accumulate long positions below the opening price with the anticipation that it's going to be a higher close and be able to profit. Now, much the same thing we talked about as it relates to a move above the opening price for down days. Well, on up days, when the opening price and then there's a move beyond and lower than the opening price, and we'll talk specifically what is the opening price later on in this video. But if we move below the opening price, that move, generally, if it's fast and thin, that will be a Judas swing. In other words, it's going to be lulling the less informed crowd to get in going short, because after all, if it moves very quickly, 10, 15, 20, 30 pips, okay, in a very short period of time, think about it. Most people are sitting in front of your charts. Oh man, I've been wanting to see a trade, and I just want to get in there and do something. And once it starts moving fast, what is it going to trigger inside their brain? You know, you've did it too. You went in there and chased it going lower. And then what's it do? It turns around and spins on a dime and vaults forward higher and higher and higher. And then you're holding on to a losing position because you didn't use a stop. You should have used a stop, but you didn't. You knew better, but you didn't do it. And then you ride this entire daily range against you until finally, around 10 o'clock in the morning, you throw up your guts, for lack of a better word, and you get out. And you've rode the entire range against you. And you did that. No one else did that. You did that. Okay. And that's the cycle that goes on a daily basis. If it's going to be an up day or down day, what I just described to you, that's what happens. Okay. So let's look at it more specifically. Now, the typical accumulation, okay, starts at the opening price. What happens at the opening price? Well, obviously, we would like to know in advance that we're going to be anticipating an up day. If we do, we're looking for a down move away from that opening price. Now, how much of a down move? Well, that's dependent upon several things that we can't answer all in this video, but we're going to give you a lot of framework each video as we go through. Once we get into specifics of short-term trading, day trading, and position trading, all that, we're going to give you very clear, specific criteria from step 1 to step 2, step 3, all the way down to the finishing of exiting the trade. Those types of details is what you're looking for. They will come later, but we have to have a foundation. If you don't have a foundation, it won't mean anything to you. You won't know what you're looking for, much like you are now. You're looking at charts, expecting a neon sign and say, okay, it's a time to buy. Okay, so what we're talking about here is the accumulation phase on a long side. When you see the opening price and you anticipate bullish move, you want to see, you are longing for, you are looking for and anticipating a down move, because that's the sucker play and the Judas that is going to lull in everybody else. That's what you want, because if they're doing that in price, you know what they're doing in advance. You know what to anticipate. When it happens, you buy in that move going lower. That's where smart money accumulates their longs. It's going to seem scary. It's going to feel like it doesn't make any sense doing it. But I want you to go back and look at your charts. It's there. Every single time it's there. It's not a 50% chance. It's not a 60% chance, okay? We're in the 90% bracket of this happening. Think about it. Do you want to trade with 90% statistical odds of being right in a directional move? Now, notice I said directional move. I did not say right on your entry price and exit price, because those are criteria that we have to answer at another time. But I'll give you more framework and precision ideas to get you very, very close to the marketplace, just like the banks. But for now, think about what that edge would give you. If you have a 90% likelihood of knowing the direction of the move of the day, and you do that consistently, how can you not be profitable? How can you not? It's just, it boggles the mind how someone with that insight can't make money. If you just add a small little risk, profile in managing your equity, by default you're going to make money. It's just, it's that apparent. Okay, when you look at the statistical odds of it happening, as much as it does, you'll know when, and your confidence level will go through the roof. The same thing is said on down days. The opening price, we would anticipate what? A Judas swing going where? Higher. We want to see that move shooting up. Above the opening price is where we're going to be doing our work to get short. It's going to lull in everybody else to go long. We are not buying into that. We're going to sell right into it. Why? Because that's exactly where the smart money is distributing longs and accumulating shorts. They're getting in, they're selling in that rally up. Remember what we talked about so far in all of my teaching. Smart money sells in up moves. They buy in down moves. It's just that simple. It's just that simple. You have to think like the banks, okay? They have a lot of money. They need it going the other way to get in their positions, okay? They're not chasing the markets going opposite direction, going short as it's dropping. They're selling into it as it rallies. That's the same thing you need to do. Now, what's a standard up bar or candle if you're looking at candlesticks? Well, the low will be very, very close to, the open will be very close to the low, typically in the lower 20% of the total range. It will be a long body in the middle, and then the close will be in the upper 20% of the range. Now, there are time specifics that we're going to talk about later on in this series too that will really, really knock your socks off. But for now, I want you to remember something. If you start doing a study on every up day and every down day on a daily chart, okay, pick one pair, don't do anything else except for one pair, okay? Follow one pair for at least 1 month. Don't look at anything else except for the dollar index, okay? Find one pair you like that's traded against the dollar, and you can stick with the majors. It could be Swissy, it could be Fiber, Euro USD, it could be Canadian dollar, Australian dollar, Kiwi, anything you want, but it's got to be one of the majors crossed with the dollar, okay? Why can't I use another exotic, or why can't I do a pound versus yen? You can do that, okay, but I want you to specifically study against the dollar because that's going to be the moneymaker for you. But I want you to understand that in up days, find the upper third or 30% mark. Okay, if you can set your fibs up and calibrate them so it shows 30% level, not that it's a fib level, but we'll say 30%. Okay, if you do that and draw the high and low on the fib, okay, and do that from the high and low and low to high, and you'll see that on up days, the opening price will be in the lower third, and the close will be in the upper third of the daily range, about 90% of the time. Now, when you have extremely volatile, explosive moves higher and lower, the close will be in the upper 20% and lower 20% on down days. Okay, and with that understanding, it's astronomical in terms of the profitability it gives you, because it will teach you to not get out with just 20 pips or 30 pips intraday. Hold for the close, hold for specific times of the day, and get the maximum lion's portion of the move. What move is that? It's the largest portion between the two of the open and close. On a down day, same thing, just opposite. The close is going to be in the lower 20% or third of the total daily range, and the open will be in the upper 20% or at least the upper third of the daily range. The largest portion of the move is in the middle. Okay, folks, we're back on the British Pound USD daily chart, and I hope you enjoyed that portion of the explanation of the Power 3. And now that we understand that there is a relationship from the open to close, okay, that's very generic. And I know most of you are probably saying, okay, well, that's all well and good, but what's the use of it? What's the benefit of it? Well, if we have the framework that this here is a stop high, a stop run on the highs, okay, this is manipulation. They run the price higher to take out the stops that were resting on those participants that were already short on the cable. We understand that the dollar index showed a break in correlation because this should have been a lower low in the dollar. There had not been any significant selling in the dollar, but there had been more buy orders, okay, running the previous high here. Why would they do that? Because the stops resting above this high for those that are already short are in the form of what? A buy stop. Why would the dealers and banks and central banks want to allow the price to shoot up there like that? To undo those orders that were going to be profitable. And the buy stops become market orders to buy at the marketplace, which engineers, and we'll talk more specifically about this as we go, and I want to give you a lot more criteria when we start talking about breakers. They engineer liquidity to give them the other side of the trade for more shorts. They were probably selling in here too, just like everyone else, that were going to be profitable as the price started to drop. They wanted to get more in the marketplace, and those participants that are already positioned profitable, they wanted them out. They want them out of the marketplace. So I'm going to remind you, this marketplace is not for your benefit. Okay, this is the bank's playground. You're in there playing with the biggest, baddest of them all. You're in there swimming with apex predators. Okay, and you have to know what they are doing. Now, you cannot beat them. You can never beat them, but you can do what they do, and that means feed on the weak. And you can argue with amongst yourselves whether or not that's ethical or not, but that's for another discussion another day. But as it relates here, we can clearly see this is a stop run. So if it's going to run the stops and the dollar saying no, 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 there's going to be upward pressure in the marketplace. Dollar was unwilling to go lower. The fact that this was not willing to go lower showed that there was a massive accumulation of buying in this. Otherwise, it would have made a lower low comparable to the higher high in cable. But because it didn't, that showed underlying relative strength. Oh no. I guess I got to pull up the relative strength index to show you that, right? No. Relative strength is the basis of what was being described in the first video of the series. That's the underlying framework or premise behind the SMT divergence. Relative to what? Whatever that's relating to it. In other words, the contrarian view of the marketplace, if you're looking at the dollar going higher, would be what in the cable? It going lower. But you're not seeing that relationship here. You're seeing the actual opposite. Okay, so this right here clues you in to the fact that the dollar was under massive accumulation. It was unwilling to go lower for a reason. It was being bought up so aggressively that the buyers were accumulating so much of the interest in the dollar, there was no need for anyone to price lower. Okay, if you want to speak in terms of supply and demand, okay, the demand was much, much more over the supply. Okay, so there was no willingness to drop it lower, okay, to find lower prices for buyers. They were happy with buying it where they was trading at here. In fact, they were more so inclined to be buyers at that price than to wait for a lower price, because they knew fundamentally, and we don't know what the fundamentals were. We don't need to know what the fundamentals are. We don't need to know that. But we know how to look at price, and they cannot hide their footprints. They're like an elephant going through your backyard. You'll know it was going through your backyard. Just walk out there when it went through, and you'll see clearly that it's indentations in your ground. Okay, you'll see it went through there. Okay, um, if you had an elephant go through your your dining room, you certainly would know it. You can clearly see it. Well, in price action, you can see it too if you understand what you're looking for. This is what I look for. You want to know what real accumulation and distribution is? You don't need it in indicators. Okay? You don't need overbought and oversold. You don't need RSI. You don't need MACD. You don't need any of that stuff. Okay? That's all fluff. It's hokey. Okay? It's based on all this stuff over here. You need to know what's going on right now going forward. And that moment right there, this is the tip off that was telling you. Now, I know some of you guys are just warming up to ICT and you're saying, well, Michael, you're looking at a chart, okay, and it's going into September, and you're talking about something that took place in July. Of course, hindsight's 2020. I will counsel you to go back over Twitter and go over all my videos through 2014 from that point on, and you'll clearly hear me say the dollar was going higher and the cable and fiber were going lower. Okay, so it's not cherry picking, it's not hindsight. So I have to throw that in there as a disclaimer, because I know a lot of you guys like to throw stones and you think you're smart because I'm talking about something in hindsight now, but we were talking about it in future before it happened. Okay, so with all that, let's go back to that cable chart and bore the socks off of you. Since we know this is a bearish indication because they are going to run the stops, we would anticipate what? Lower prices. Now, enter Power 3. We have a concept in the ICT camp called mapping. Okay? We want to keep our focus on specifically looking for the sell side of the marketplace. In other words, we want to be going short. Any opportunity to get short, we want to be looking for that if it lines up with time of day. And we'll talk more about time of day later on and day of the week. But for now, I want you to look for what we discussed in Power 3. The premise was, based on the higher time frame, that this puppy was going lower because the dollar was going higher, right? We discussed that. Well, what's the lower move in price going to look like if we look at it in the view of Power 3? Well, let's look at it. We have the open here with a lower close. Now it closed just a little bit below the opening price, but look at the move that had transpired going lower just the very next day. And then the next day here we have it. We have it open, a high, and then slammed lower, and off the low it closes. Is this not what was described in Power 3? Sure it is. What about this one? Same thing here. Now the close did come up on the low pretty aggressively, but we're still very close to the overall peak of the overall move that's taking place. Now again, this is a higher time frame move, so you're gonna have to give it some time to unwind. Very next day, this is a Sunday, then you see here, Power 3 again, open, rallies higher, trades lower, off the low, closes in the lower third of the bar. Same thing, open, rally. Look at the move from the high down to the low. That's just the opportunity that's there. Okay. Same thing here, open, rally, down, close. Look at this, open, rally, down, close. Unbelievable, right, guys? Here another one, small one. Open, rally, down, close. Sunday. Monday, we don't like to trade anyway. Tuesday, open, rally, down, close. Open, rally, down, close. Open, rally, down, close. Open, rally, down, close. Do you see a repeating phenomenon here, folks? Am I boring you yet? I'm poking you right now. Can you feel it? You awake? Price has a small little minor retracement. Okay. Again, say you lost on this day. Say you lost on this day. Look at all the winning days you would have had here. Okay, do you think you would have made money to overcome the losses that you would have taken here, even if you were just looking to sell above the opening here and sell above the opening here? Think about that. That's what I want you to do. I want you to be realistic and say, all right, I know what you're saying, Michael, but let's assume that I really fudged it and screwed it up a couple different times. You can still be profitable taking losses. Think about it, okay? Now here, again, we go back into the cycle again. We have open, rally, down, close. Open, rally, down, close. Open, rally, down, close. Sunday. Monday, we don't trade. Tuesday, look at this. Oh, we might get a losing day. We're out. We lost some money there. Okay, here's another day. Here, look at this one. Open, rally, boom, hello. How like that? Salad days are back. Okay. Another one here, open, rally, down, but it's just slightly off the close, but that's fine. Another day, you could have potentially lost money there. Sunday, Monday, we don't like to trade. Open, rally, down, close. Open, rally, down, close. Open, rally, down, close. Open, rally, down, close. Okay, you see what I'm saying? Okay, do you see what I'm saying here? How many pips do you think you could have harvested out of that move with the higher time frame premise in mind? 20, 30, 50, 100? Do you think you could realistically take 30 to 50 a week out of the market doing that? Just looking at one pair? If you looked at any of my work, I've already taught that you could double your money every single year, regardless of what your equity size is. You could double your money every single year, which is 25 pips. 2% risk, trading like this. You only got to do one trade per week. 30 pips is a bonus. 50 pips, you're making all kinds of money. And you don't need to trade every single day. But you know what the dealers are going to do. You know what the banks are trying to do. And you don't try to arm wrestle them. You don't try to get cute with it. You don't use your indicator. Well, this is what it's saying on the higher time frame, but my MACD says it's a bullish divergence, and I just want to be a buyer. Forget all that. Forget all that. Okay? If you do that, you are a retail trader for life, or until your account's gone, and that's the statistical odds. You will lose your money in time if you do not use these concepts. I'm telling you, you have to have a higher time frame premise. You have to. If you are just now developing, you have no likelihood of having any longevity unless you at least start from the higher time frame and work your way down. Because if you're looking at 1 minute and 5 minute charts right now and you have no basis for understanding what's going on, you're not going to see this. You're not going to see this because it's too big. You're too close to the tree to see the forest. Okay, so now let's take it one step further. Okay, because I know you're probably all saying, well, this is great. Now you can't sleep, but now I'm going to really give you insomnia. Let's go over in this same time frame. Okay, we're going to look around the July 14th or so to the end of August. Okay, we're going to go down to a 15-minute time frame. Okay, and look at this right here. This is a mess, right? This is a 15-minute time frame. Now, I want you to think about stops for a moment. We're going to look at this chart for a second and just look at it, okay, with no framework whatsoever, okay. There's a technique that I use called turtle soup. Turtle soup is a trading pattern that I learned from Street Smarts book. Linda Raschke and Larry Connors wrote this book, and I paid $175 for it, and I would have gladly paid more for it had I known what was in it, because I've made a lot of money off the pattern. It is worth a lot of money, but its premise is false breaks. Okay, and here's what I'm talking about. Here you have a high, rallies above it, it's fake. Everyone will look at this as a bull flag, sell it there. Boom. Look at this low here. Price goes just below it here and it rallies up. Okay, price rallies above that high here, sells off. Where does it go? Below this low here. Okay, this low here is violated where? Right there. Where does it go after that? Higher. What's it doing there? Running the stops here. Where's the stops at now? Below this low. Well, the sell off is going to be from here to take out the stops there. Makes a low. Okay, starts to rally. Where's the stops? Below the low, right here. Comes down, blows those stops out. Where's it going now? The stops above here, here, and here. This is where all the liquidity is. This is a liquidity pool. Okay, this is what I call a liquidity pool. P-O-O-L. Okay, this is where a pocket of stops is going to be resting. They'll come up, clear all those out. Okay, where's the stops at now? Below the market, below this low. Market trades lower and lower and lower. Boom, takes out that area of liquidity. Okay, in here, same thing. We have a low violated right here, rallies. Where's it going to rally? Right above this high where the stops are. Look at this high here. Okay, it trades all the way down, blows out the stops here. Okay, and rallies back up. This move here is on the heels of running out this little short-term high here. This low here has stops below it. It's blown out here. Okay, this little short-term high here, stops and liquidity above that, rests below it, boom, takes it out. Okay, I want you to look at price charts like that. Where are the stops? Where are those traders positioned that's making money right now? wherever the market's trading, higher or lower, ask yourself every single moment that you're looking at your charts, where's the money? Because that's really what this is all about. On the short-term time frames, it's not about your RSI and MACD. Okay, it's about where the money is. Because where the stops are, that's where the market's going. I know this for firsthand knowledge. I'm telling you, I can't take you back in time and sit you at a desk inside of an office where I saw this going on. I'm telling you, this is how it works. That's the game. Take the stops, get the liquidity, position yourself, ride it. Drive it against the retail, drive it against the funds. Okay, squeeze and squeeze and squeeze until they give up their position, and then that liquidity is where we get in or get out, either getting in a new position or taking profits. That's the whole nature of trading. Now, we're going to talk about true day. Now, what is true day? Another concept you guys have not heard about before. Well, it's, again, something that the retail world doesn't know. When you look at price action like this, okay, and if you're on MT4, and that's what I'm using here, it's just a demo account to show you. If you hold down Control and you tap Y, this is what you get. You get your day dividers, okay, and that's pretty good. I mean, you can go away with some really good insight with just using that, okay. But I want you to go to the nth degree, like I have, and really understand what's going on in the marketplace, okay. We're going to come back to these dividers in a second, but right now let's just take them off. Okay, and I want you to now consider this. Okay, what I just delineated was 1900 hours. Okay, 1900 hours GMT. Now, what is 1900 GMT? If you know anything about what I've taught for a number of years, I teach that the very, very last portion of the financial trading day that is going to encapsulate the high or low of the day is going to be during the 1800 hour. Now, because it's during the 1800 hour, when does the 1800 hour end? At 1900. Now, I want you to look at what price is done just between these two price points, okay? Because we're going to really, really zero in and give you, raise your hand if you saw the movie The Matrix. Raise your hand. I'm looking for it. All right. You know what I'm talking about when I say when Neo finally wakes up, if you will, and he can see the Matrix as it really is. You know, when we look around our room or whatever, I'm looking around my office and I see all the things in my office, and you see the things around where you're at. Okay. In the Matrix, okay, what he started seeing was the zeros and ones, the binary code that makes up the illusion that he was perceiving as everyone else was looking around too. Well, what I'm about to show you, you're actually going to see the market for what it really is. And it's been staring in your face every single day, but you've been unaware. Okay? So now watch what happens. We're going to add one more little thing. Okay, so now what we have here is delineated the 5 GMT time. Okay, now what is 5 GMT? Well, what that is midnight time in New York. Okay, now I want you to look at price with the understanding of power 3. Okay, what is the open, rally, sell into the high, and down move and close lower look like? Well, with true day perspective, okay, this is how I want you to view the price chart. Okay, this is how I want you to view the daily range. Forget what we talked about by having the Control Y thing. Forget that for a minute. I want you to look at just primarily what's being shown here. Okay, I'm going to start from left to right. We have price here. Okay, 5 GMT is midnight. Okay, price rallies up, makes a high, trades lower. Okay, comes off the low, closes here at 1900 GMT. Goes in sideways consolidation during the Asian range. Okay, and then what happens at 5 GMT, midnight? Okay, it rallies. You want to sell that. Where is it going to go up to? Well, it's going to run a previous high, take out stops. Why? Because that's where liquidity is. Okay, they're going to sell into that right there because there's going to be buyers here. They have been profitable here, right? Well, this is the Judas swing, the rally up. That move, okay, that move also will be the high of the day. And we want to capture some move going lower. Now, we're going to talk about specific times of the day, but we're just going to look at the overall range that's possible for each one of these particular moves. Okay, selling, now again, I'm going to give you the worst case type scenario. I'm going to just use a little bit away from the high and not to the low. Okay, so there's 38 pips that one day. Okay, here's another, the very next day, we're in a consolidation here at 5 GMT. We're looking for what happening? A rally to sell into. Here's a high that stops will be resting just above. Okay, that's inside the Asian range. When it rallies up like that, everyone else is going to think it's going higher. It made a 1, 2, 3 bottom. Okay, it made a pin bar. Sell it here, holding on throughout the profit release portion of the move, power 3. Okay, here's the low, but we're going to come off that low. So we got it here. Here's 54 pips. That's one day. Okay, here is a day that roared against, okay, it roared against those that would have been short in here. Was there any indication in here, okay, that gave you a bullish scenario? Possibly. But we're going to argue and say you lost money on this day. I want to be fair about everything I'm explaining to you. Say you lost money here. Say you took a full 30 pip stop loss, because that's a typical stop loss for me if I'm trading in London. Okay, there are ways to trim that down, but for beginning stages of your development, I want you to think 30 pips. Okay, say you took a full 30 pip stop loss there. Boom, you're blown out. Are you underwater yet? No, not if you took these trades back here. You're still profitable. Okay, the very next day here, this is your 5 GMT time. Price rallies up. You want to sell that rally. It's the Judas swing. In here, selling up here, not the very high. And total range down here is 34 pips. Could you get 25 pips out of that? Maybe. Don't know. Can't be for certain, but we're giving you the likelihood of how these things unfold. What does power 3 look like? In here, very, very little move in here. So I'm going to be fair and say you probably did not get anything on this day, despite it being profitable if you had gone short. The very next day here, here's your rally up. What's it doing? It's taking out this short-term high. That's where the liquidity is. That's the stops. That's the nature of the Judas swing. That rally up after 5 GMT. At midnight, I want you to put a vertical line on all your charts. 5 GMT, if you're in the States like I am on the East Coast. Wherever you're at in the world, find out whatever your platform shows for 12 midnight in New York. And you want to look for, in down bearish markets, you want to see a rally up after that and sell that. Sell right into it. Use a 30 pip stop. Once it blows out a short-term high in the previous day, in previous trading session, that's what it's doing. It's going back in the previous range, taking stops, drawing in liquidity. Boom, sell it. And here, I already know you guys are going nuts right now. I can feel the vibrations and energy. All right, you can't stop smiling, can you? Okay, not selling that very high. We're going to sell right here in this bulk of this little consolidation. The total range available for that day was 75. Could you get 50 here and feel comfortable taking out this low here? Just aiming for that? Not even getting all this, just getting something like this. 50 pips right there one day. Okay. Another trading day here where it really didn't give you too much, but this is another setup that we'll talk about that we're going to say you missed it that day. And we're going to be fair. You missed it. Okay. Same thing here. We're going to say you missed it as well, even though there was an opportunity to trade here when we start talking about New York. Perfect scenario here. Consolidation during Asian range. It rallies up. What's it doing here, guys? This is a Judas swing. It's sucking everybody in. We do not concern ourselves with the initial drop down. We do not chase that. We're looking for what? An up move. Why? Why are we looking for an up move? Why are we looking for an up move on the 22nd and 23rd of July? Why are we doing that? Because over here, we're in this down move that's underway on a large time frame. So why are we looking for longs? We're not looking for longs. We want to see price move above and fake people out, taking out stops here and here in the previous day's range. Okay, see that? Not to mention going back to a previous order block, which we won't discuss yet. Selling it short here. Okay, and again, not getting to very high. We're going to be fair and say we were selling it around in here. The total range for the day was 62. 50 pips is right there, which is right here, which is a good target. Why? Because it's taking out the low here and the stops low here. Okay. Now, do you get the underlying theme of what's going on here? Consolidation, the Judas swing up, taking out stops, sell it, hold it for the profit release portion of the day. Bingo. Are you counting your money yet, guys? Here's the high. We're going to get in here, and the low is down here about 75 pips or so. We're going to say 50 pips is right there. So you just aim for 50 pips. Okay, boom. You leave a little bit on the table. So what? Okay. I'm not saying that you would do that, but I'm being realistic. Say you did. Okay. Stop for a moment. Now I can go on and go on and go on and go on, but I want you to go through your charts. I want you to do this. I want you to see it. Okay. Do you see the power three concept that I was talking about? Understanding the Asian range between the blue line and to the right to the dotted line here. Okay. All this is the Asian range, quiet time. Okay. We're going to start building on this whole time frame prior to this and give you even more insights and precision. But for now, just understand between the blue line to the right to 5 GMT, you do not want to be trading in there. Don't want to be trading, but you want to be studying price, and you want to see if your higher time frame is calling for lower prices. What are you looking for specifically? Now think about what I just gave you. I just opened up Solomon's mine. All the money that you'd ever want to make has just been given to you. All of the opportunities in the trading signals and systems, okay, that you believed were out there, okay, all those pale in comparison to what I just gave you. I just showed you exactly how the intermarket bank works. Think about that. I just gave you everything that the retail world doesn't know. And I didn't give you an indicator. I showed you it in price. Now, I didn't just cherry pick this. I didn't cherry pick this. I showed you the beginning from volume 1 through volume 2 to volume 3. And I'm going to tell you, it gets even more crazier than this. Much more precise than this. Much more anticipatory than this. But before we get to those stages, you have to understand what you're looking at here. What is the Power 3 look like? How do you identify it? What are you waiting for? When does it happen specifically? Because there's a group out there that will say you can't time the market, and I laugh in their face every single time. Believe me, you can time the market, and you can know exactly what levels to look for. You know exactly the type of phenomenon that the dealers and the market makers are going to do. Okay, Steve Morrow ripped my stuff off. This stuff I didn't teach him. I didn't teach this to anyone. Okay, this is now just being revealed for the first time, and I've been doing this for about 12 years out of my trading career, and I only gotten really good with it in the last 8, because I tried certain things with it when I first learned it, and it just didn't didn't pan out. I wasted a lot of money trying to reinvent the wheel. But this is what goes on in the marketplace. This is how you frame the true day. Okay, understanding what's going on between these intervals, understanding what is the manipulation that takes place on a daily basis, guys. You want to look for this if it's bearish. And obviously on the contrary side, if it's bullish, it would be the opposite. You'd be looking for from 5 GMT here and this here, you would look for a move lower, taking out stops and then buying into that with the profit release portion moving higher in the day and a higher close. And it would just repeat that going through. And I want you to study your charts. Go through your charts and do that. Okay, it can come up with any color scheme you want, whatever whatever suits your eye and whatever you like, but you're delineating the 1900 hour and you're delineating the 5 GMT time, which is, to me, okay, it gives you the real total range of the day, and it removes all of the unnecessary price action, and it really hones in your eye on what it is specifically you're looking for, and it gives you the framework to profile the market looking for a Judas swing, because everyone thought that on baby pips I was just talking about hindsight, talking about, well, here's where it worked out perfectly. No, 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 no. No, no. I knew weeks in advance what I was going to be doing, as long as a certain criteria was in the marketplace, like we're talking about here, higher time frame premise. I'm going to milk that bad boy for weeks and months until it gets to the opposite side of the spectrum and reverses. I don't need to time the reverse. I'll let it happen, and when it does, I'll milk it the other side, the other side of the market. Okay, and that's what gives you longevity. That's what gives you peace of mind. It gives you confidence, and there's nothing you can put this against that this won't destroy. No EA, no moving averages, no supply demand crap. Okay, all that it pales in comparison. When you understand what the higher time frame order flow is on an institutional basis, when you understand that, when the market's very, very heavy, all you have to do is sit back and wait for the manipulation to happen at this type of phenomenon. This phenomenon repeats over and over and over and over and over and over and over. It does. It, I can't stress it enough. You won't believe this until you see it in your charts. Trust me, it's there. It's on all the pairs. Now, I'm going to release you in this volume with a great level of anticipation, because I know once you see this video, you're going to be ecstatic and you're going to be contacting me. And if you follow me on Twitter, you're probably like, wow, that's pretty cool. And I'm anticipating that because I already know I already blew your socks off. And here's the one thing I want you to know. It gets better than this. So until then, guys, I wish you good luck and good trading.